Hello, welcome to America First Wealth Management Investment Outlook for December 30th, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First. This is just our standard disclaimer. We're just offering informational purposes information. We're not offering investment advice or recommendations to purchase or sell any securities. This is as of today's date, December 30th, and it's subject to change without notice. In terms of our market outlook, we think year-end portfolio rebalancing may be triggering a bit of a sell-off into year-end. We do believe the S&P 500 technical support level is 5681. Market is still looking like it's in a bull market mode, and we do have some support levels here. A little sell-off due to rebalancing, especially by large institutions, which typically adhere to an asset allocation mix, leads us to suggest that they're rebalancing into fixed income and possibly cash. There are some concerns about the U.S. debt limit reaching its limit level in mid-January. After that, congressional approval will be required to change that debt limit. So there'll be some debate and discussion about that, certainly into the new year. Meanwhile, the 10-year U.S. Treasury rates continue to rise, which is a continued problem here. When we look at the S&P 500 forward PE ratio, it does appear to us to be high versus history, and that has a tendency to be associated with lackluster long-term stock results, and we'll have a pretty good chart about that. We do believe that breadth needs to develop in order for the bull market advance to continue. Much of the advance in the S&P 500 has been concentrated in a handful of very large names. As we move into the new year, all eyes will be on Trump's policy and executive actions as he takes office on inauguration date, January 20th, 2025. Looking at equity fund flows, last week we saw a large outflow from equities, 35.3 billion net outflow last week, and that's the largest weekly outflow we've seen since December 2022. And this is a sharp contrast versus the weekly net inflows of about 14 billion since the Fed began cutting interest rates in the fall. So first big drop here, and we think the magnitude does suggest it's rebalancing versus anything that's fundamental that's going on. And where has money been flowing? This is the ICI money market funds flows, and you can clearly see that money market assets are at about 6.75 trillion now. So a lot of money has, we believe, leaving the market and sitting in short-term high-yielding money market rates. And that certainly near-term has been a drag on the market as money's flowed out. But longer-term, that gives us a lot of dry powder in case investors decide to go back into buy stocks. And I'm sure they're thinking about looking at cheaper valuations before they jump back in. And certainly lower interest rates would drive money out of money market funds, but right now we're still seeing relatively high historical short-term interest rates. So investors are probably happy to be parked out there. This is a bad picture of Janet Yellen, but this does represent a headline story that's out there that the U.S. may hit new debt limit as early as January 14th. And that would require some extraordinary efforts by Congress, the Treasury, and the Fed to coordinate and to orchestrate a lifting of those limits or some sort of financial engineering. Debt levels are very high at roughly 35 trillion for public debt, and that's certainly something the new administration will have to contend with. With the higher interest rates we've been seeing, and also the interest expense, this goes back to 2006, by the way, the US interest expense is at a very high level, and that's at the green line on top, versus defense spending in the blue. And I'm sorry, defense spending is the green on top, and you can see that the uh, gross interest expense, which is in red, is rising, and starting to get to a point where it's raising a lot of questions. Gross interest expense is higher than Social Security spending and healthcare spending, and it looks like it's going to be catching up to defense spending. So this is a concern because interest service takes away federal spending away from other areas which are certainly important and vital to the interests of the country. And this is the first time it's happened here. This shows the Fed funds rate versus the 10-year yield. You've seen a 100 basis point drop in the Fed funds rate since the Fed started cutting rates this fall. And at the same time, the 10-year yield has gone in the opposite direction, rising 100 basis points. So it's telling us that the markets and investors are concerned about a resurgence of inflation, which is reflected in uh, a rise in the 10-year yield. It's also concerned about the high rate of interest as well. So it's something that needs to be dealt with by the new administration very quickly because the markets are demanding a policy or fiscal response to this. And this is a long-term chart of US debt outstanding. And you can see we're at about the 35 trillion public debt mark. And this chart is definitely gone exponential. And as many chart watchers are aware of, these types of charts cannot continue ad infinitum. Something will happen or break and will need to be addressed. This chart shows the S&P 500 forward PE ratio, which is represented by the horizontal axis. We're currently a little below 23 times on the S&P 500 PE. And as you can see, it's towards the high end of the historical. Each dot represents the forward PE level and the subsequent 10-year return of the S&P 500. So you can see that the current high level of PE has been associated with lackluster 10-year performance for the next 10 years. So we're at a point where one can expect great difficulty in having very high returns. Whereas if you look at something like 11 times forward PE in the past, it's been associated with 10-year returns going forward in the order of magnitude of 15 to 20% annualized. So we're at the rich end of the PE, which tends to be associated with a lackluster return. So it does raise a caution and warning flag. It doesn't mean that next year will be a bad year. It just means that the next 10 years will be difficult. And as market watchers are quite aware, corrections in the market tend to happen in the span of a 1, 2, 3 year time period. But the other period of time could be a rebound from that level. So I think investors are doing the right thing, having a healthy balance of assets and cash and bonds and being diversified. So we're not sending a message to be out of equities, but it's important to have some dry powder and be ready because when attractive valuations come again, it'll be time to put money to work. And this chart shows that the the breadth of the market has been dominated by a small group of stocks. In fact, the top 10 names in the S&P 500 by market cap now represents 40% of that index. So for active managers and retail investors to perform, you really have to be concentrated in a very small group of names and not be too diversified. And this is a very good chart that JP Morgan put out. The average retail investor at the bottom in black averaged only about a 9.8% return year-to-date 2024 versus 25% for the S&P 500. So even though the S&P 500 is up a lot, the average retail investor is not up. It's up positive. 9.8 is nothing to sneeze at, but it's a wide margin difference between the S&P 500. And if you look at the historical gap, this is probably one of the largest gaps the retail investor has had versus the broad market index. So it's a big anomaly, and it goes to stress that most investors are probably better off just investing in the S&P 500 index versus trying to do it on their own. So this is another good example of that. And it also suggests that many investors are afraid to get into the markets right now because of the run-up in the S&P 500, which is illustrated earlier with the fund flows into money market accounts. Turning to the weekly market stats, which we show every week. Last week was largely a decent week for the markets, with the exception of the S&P 500, which is down 5 basis points, just essentially flat. And drop in bonds is on the bottom line. It's measured by the core US bond ETF, the AGG, down 33 basis points. 40 year to date, as you go over into the third column from the right, still very healthy return. Dow up over 14%, S&P up 25.2%, NASDAQ and NASDAQ 100 being the strongest benchmarks, along with the Russell 1000 growth. So we've had a very strong year for equities. Haven't had a lot of participation in terms of breadth. As you can see, the Russell 2000 index, it's up only 10.7% versus the much higher returns for the other more growthier indices. Interestingly, international stocks was one of the laggards in equities, up only 4.17%. Turning to the Magnificent Seven, year to date, what jumps out to us is early in the year, Tesla was down the most, and it's caught up in the last quarter, especially after the presidential elections, and Tesla is now second best performer of the Magnificent Seven, up 73.7% for the year to date. Leading the pack again is NVIDIA, after leading the pack 2023 as well. So about 177% return year to date for NVIDIA, following a 239% in 2023. So this looks like it's continuation of the AI trend in demand, and NVIDIA has become the second largest stock in the S&P 500, taking over the number 2 spot from Microsoft, and is just trailing Apple as which is currently the largest company in the S&P 500. For the week, we had 5 out of the 7 names were up. Microsoft and Amazon were the only 2 names that were down. It was a choppy week with the Christmas break in between. I believe Monday and Tuesday. Tuesday was a half day. We're up, and then we had a sell-off after Christmas. So one can say we had a partial Christmas rally, but it didn't follow through, and it's been a post-Christmas sell-off since then. Turning to the sector performance of the week, did have a pickup in energy prices as we saw a cold spell in the country and demand for oil and gas picked up. And along with it was the strength in the energy stocks, up 1.34%, the Energy Spider ETF. And we'll run through these in detail, but yet healthcare and financials were second and third. Tech was in fourth place. At the bottom, materials and consumer staples were the underperformers. Turning over to the year to date, we do see clear leadership in communication services, financials, consumer discretionary, and technology stocks for the year to date, as well as utilities right behind the leading group. So it was a very good year across most of the sectors. It paid to take more risk and be in the consumer discretion, consumer services, and tech forward areas. Despite the rising interest rates, financials did quite well. So it was a pretty solid year across most sectors, and we think for 2025, we do expect the markets to start off strong, and there'll be a big question mark around the inauguration period, and we'll see if the markets sell off after the inauguration as the reins of power are handed over. And we'll be watching the policies and executive actions very closely. Post-election, S&P has been up. Obviously, a little more recent volatility around December 17th to the end of the month here. And this is a short-term picture. We'll probably stop posting this chart next week since we'll be going into the new year. This is the one-year chart of the S&P 500. As we had noted before, that the S&P was in the oversold range according to the RSI, and as expected, we did get a bit of a sell-off. The slight turn down in the 10-day moving average, the S&P is a little bit of a negative, but not a big concern. We don't have a very strong drop in the index, and after the run up since August, it's normal to have a consolidation period, which we're seeing now. Turning over to a chart that Jim Monahan, our COO and also resident chartered market technician. Jim has a CMT and does a lot of really good charts, and he provided this one recently showing the trend line support for the S&P 500 on a weekly basis. The uptrend that he noted that started in October 2023, drawing the line through the bottom points on the chart Jim suggests a trend line support of 5681, which the S&P is still above, so we are not concerned that we're entering a downtrend here as long as that trend line support is holding. And we do look for bounces near that level. Any break in that level will cause us to look for other reasons why we're breaking support. But this chart shows we're still trending upwards. The 10-year Treasury yield, looking at about a 3-month high. 10-year yields ended at 4.62. This should actually be 1227. Sorry, I didn't change the date on that. And we were up 10 basis points for the week. And now the S&P, the 10-year yields are up 74 basis points versus the end of last year. So the spike up in 10-year yields remains a continued problem, especially with the debt ceiling limit being potentially reached in mid-January. And we also have a fair number of refinancings and debt issuance by both the Fed and corporate. And there's a large amount of commercial real estate debt that's coming due in the next 6 months. I think I saw estimates of 1.5 trillion. So a lot of IOU paper that needs to find a home, and we think it can put additional um, pressure on 10-year yields. And as we know, that's going to create pressure on financials, on mortgage issuance, home buying, refinancing, and new home construction. So that's going to put pressure, unfortunately. It'll also put pressure on equities, as I showed in the chart before. The 10-year returns tend to be lackluster when the S&P 500 forward PE is high. So as we get closer to let's call it a 10% yield on the 10-year treasuries, we may see investors deciding to park money in 10-year bonds and earn the 10% annualized versus trying to risk a 10-year return that can tend to be flat to negative according to the historical data. Um, so we'll be watching this dynamic carefully. There'll be long-term investors that will obviously reduce risk, and there'll be shorter-term investors that want to take risk. And we think there's going to be a bit of a barbell. There'll be investors trying to take risk, especially some of these growth for your momentum names, especially we've seen it in the AI and technology space. Uh, and we think investors will look for those quick returns, but they'll also be quick to get out. So it'll be a bit of a fast money trading environment, and not for the average retail investor, but leave it for professionals and day traders to try to capitalize on that. And this is the yield curve. The top line in blue is the yield curve for last week, December 27th, and it's still rising versus you can see the week prior, December 20th. And it's starting to be a little less inverted, which we can clearly note. It's starting to take a normal shaped curve. We still need a drop at the short end, which may happen if there's another rate cut or two by the Fed. And we'll see. The odds are now that the January rate decision will be flat, uh, but who knows what's going to happen. The Fed will be looking at some of the data points. We have some additional inflation data points and jobless data points coming up shortly. And the surprise would be that the Fed does cut again. And I think it might be best to get the cuts out of the way at the beginning of the year and have them work through the rest of the year, hopefully, and get the economy improving again and the yield curve back to a normal shape. The new normal, in our opinion, could be slightly higher inflation, but also higher interest rates. This tends to have the effect of creating some velocity of money in the economy, and uh, as market watchers and economists know, the more velocity of money you have moving around does tend to be stimulative. So we are likely not to go back to the older days of low inflation and low interest rates, but we could potentially have higher velocity of money, slightly higher interest rates, slightly higher inflation, and that might get people to move, take risk, spend, and invest. Turning to the economic calendar, which is kind of light this week. Monday we have Chicago PMI, pending home sales, and Dallas Fed manufacturing. Tuesday will be some housing and home data, Case Shiller. Home prices month over month, year over year. And at the end of the day, we have some oil stock change, API crude numbers, expecting a draw of 3.2 million barrels. We'll be watching that closely to see if that triggers another increase in oil prices. Wednesday, the markets are closed for New Year holiday. And Thursday, we have a typically, which is the Wednesday data coming out on Thursday. Initial jobless claims will be an important number, 8:30 a.m. And that will be a number that I'm sure the Fed will focus on for their January rate decision. Friday, ISM manufacturing PMI, another important number to focus on. Hopefully we'll see a moderate change in the PMI. Consensus is 48.3, slightly down from the previous of 48.4. So that's a relatively quiet week again, punctuated by a midweek holiday. We do expect trading volumes to be lighter than normal. We're seeing volatility in some speculative AI technology names and quantum computing stocks, and we're still seeing some rebalancing going on, but we do think that the large withdrawal last week was probably the bulk of it. We might see some more selling as we get into year end on Tuesday, but Thursday will be the start of the new year in trading, and we expect a nice start. And looking forward to what the Trump administration brings. And we'll be watching closely. Thanks for tuning in, everyone. And if anyone would like to set up a meeting or have any discussions with us, we'll find out more information about our products and services. Our contact information is listed here. Please feel free to drop us an email or log into our website at AmericaFirst.fund to find out more. Thanks, everyone. Have a happy and healthy new year, and we look forward to talking to you again in 2025. Take care.